Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, we have Julian Ray. He's the director of derivatives, data, and valuation services over at IHS Markit. And we're going to take a look at the transition from LIBOR to different types of benchmarks that are going to be published by central banks very shortly. Julian, it's great to have you with us. And LIBOR is expected to disappear at the end of 2021. What's the situation today? Central banks are working with coming up with new benchmarks.
Sure. Thank you for having me, Jill. So I think it's interesting because obviously we all know that LIBOR is going to disappear. There is a lot of uncertainty around the timing. So we know that after 2021, the FCA will no longer compel the banks that submit to LIBOR to continue to do so. So that's the key date. So at the moment, what's happening is in all jurisdictions across the world, major financial markets, central banks and regulators have been looking at new benchmarks and new solutions to replace LIBOR. For example, in the US, we've got SOFR. So the Fed has been publishing this new benchmark, started in April last year, so it's been around for about a year now. We see some liquidity in the derivatives markets, some liquidity as well in the futures markets. Some issuers are also using SOFR in terms of issuing new debts, but unfortunately at the moment, the maximum maturity is about 3 years, so the market is still very new. Another example, for example, in Europe, Esther is the replacement for Euribor. Not yet published. The ECB is going to publish that new benchmark around October this year, so that's another situation much harder to deal with. And I just want to cover the UK because I think it's quite interesting. SONIA is the new benchmark that's been selected by the Bank of England for the UK. It's a benchmark that's been here for a long, long time, and the liquidity in that space is much better. So if anything, our view is that SONIA should probably be the one that will drive a lot of new liquidity. But again, very new and a lot of things to do in that space.
Are there any inconsistencies in terms of how they're calculated, what they represent?
Yes. So the thing they have in common, all of these new benchmarks are overnight benchmarks, overnight rates. So the good thing about this is that it's much better than LIBOR in terms of being representative of the cost of funding for the banks. Most of the banks will use repo transactions to fund themselves overnight, so the new benchmarks in that way are much better than LIBOR. However, what's quite important is, for example, SOFR is a secured benchmark based on repo transactions again. You look at SONIA, you look at some others, they are actually unsecured, not based on necessarily transactions or secure transactions. So what that means is in such markets such as the cross-currency swap market, if you start to do a SONIA versus SOFR cross-currency swap, which is a very vanilla and standard way of exchanging flows between two different jurisdictions, it becomes way more complex in terms of the behavior of these benchmarks compared to what it is today with LIBOR. So effectively, the methodology is a bit different across, and that's not helping the liquidity.
Let's go back to the liquidity conversation. Mm-hmm. What do you need to do to drive more liquidity in these new markets?
So a couple of things. You want to have I would say your base covered. So you want to have strong fallbacks in your contract. You want to have standardization across the board. So if LIBOR disappears, you have a contract referencing LIBOR in 2021. LIBOR is not there. What do? You want to have in your waterfall, you want to go to something that is standardized across the board. Otherwise, you're creating, a very fragmented market. So that's one thing. ISDA, LSTA, all of these associations have been working hard on doing this. One thing a bit more proactive is the new RFRs or new benchmarks, typically being overnight, are difficult to use in the cash markets because they are overnight. You could compound them to a term to make them look more like LIBOR. However, if you do this, you don't know the value of your coupons until the end of the period. That's what we call compounding in arrears. So that makes the adoption in the cash market a bit more difficult. And one of the solutions potentially would be to have what we call term risk-free rates, or TRFRs, which would be almost like alternative benchmarks to the RFR, highly correlated, but much easier to use in the cash market for driving the adoption and the liquidity.
All right, to wrap up here, sounds like there's a lot of moving parts here. There's certainly concern around fragmentation, a little bit of uncertainty. Do you think the industry is going to be ready for transition in 2021?
I don't know. I hope so. I hope so.
And what if it's not ready?
So if the industry is not ready, that's a good question. I think regulators may be a bit more lenient, but to be honest, I mean, we've got statement from the Fed and from major regulators across the board. saying LIBOR is disappearing, you need to do something about it. So the three key things you need to look at from a legal perspective: look at repapering your contracts, you look at these fallbacks. So engage today and inventory, all of that kind of work will help a lot. Technology, make sure your technology is ready. If not, and LIBOR disappears, you cannot book a trade, you're in big trouble. Yeah. And the last one, which I think I wanted to mention today, is pricing and valuation. Data, price discovery. These markets are very illiquid at the moment. They are going to build up in the years to come. You want to be in a position where you can price these new products, and you can be comfortable with the valuation of these, so you limit the value transfer when you're moving from LIBOR to something else.
All right, Julian, thank you so much for joining us at MarketSite.
Thank you, Jill.
And thank you for joining me on Trade Talks. I'm Jill Malantrino, Global Markets Reporter at Nasdaq.